Good afternoon, everyone. Thanks for joining us today. We have an interview with Good Natured, which is always really exciting. I find these interactive ones a lot more interesting, at least for me. With me again, I have Paul Antoniadis, CEO of Good Natured. Before we get started, a few things. I will be leading the Q&A, but for audience members, feel free to put any questions in the Q&A box and we'll get to those. I am going to try and go through things thematically. So if your question doesn't get answered right away, it's probably because I'm saving it for that section of the discussion. And as always, this presentation will contain forward-looking statements. If you'd like to know more about those, you can find them on the company's presentation on their website. And with that out of the way, I'd like to introduce Paul Antoniadis, CEO of Good Natured. Nice to see you, Paul.
Great to see you. Thanks for having me again.
Yeah, it's been, I think, 4 months since our last update. I think it was November. So you've had a couple releases out since then, including your preliminary Q4 numbers. So maybe we can start the discussion there and you could talk a little bit about those numbers.
Well, sure. Like we finished 2021 with a lot of momentum. We were well over 300% year-over-year growth. Our gross margins were right smack in the middle of the fairway. Our total revenues exceeded most of the analysts' expectations. So we felt like that kind of set the stage going into the current year.
They were great numbers, especially after your Q3 numbers, which I think were a little bit weaker on margin. Is that correct?
Yeah, I mean, Q3 is gross margins were still within our range, which is 21% to 28%. It was on the low end of the range, primarily due to the mix change with the completion of the X-Tech acquisition, along with some larger mix of national accounts. But that was our first quarter where we really took on the first real jump in inflationary pressures through the supply chain. So even though it was on the low end of the range, it was still within, as they say up here in Canada, between the goalposts. So
I like that you're getting the hockey references.
We're in the playoffs, so I got to throw in a couple hockey analogies.
Are we? I don't even know. I'm a terrible Canadian, I guess. We are going to talk more about those inflationary and cost pressures later on, but just going back to the revenue numbers, I think you said you were ahead of analyst estimates. What do you attribute the stronger revenue numbers to in the quarter?
Yeah, I mean, I think it's execution, both strategically and operationally. So, strategically, as we talk about half of our growth, coming from acquisitions, half of our growth coming from organic initiatives. I think, we completed 2 acquisitions. Granted, IPF was literally at the end of 2020. So we still treat that as a first quarter 2021 acquisition. And then we did X-Tech. And then you layer on the increase in customers, active customers, the new product launches. I think that all played a great reflection on our strategic team executing. Now, operationally, the team knocked it out of the park. So I think the combination of strategy and operational execution was a key factor. I'll also kind of maybe emphasize, which I think I probably sound like a broken record on this, but it's really important. Like this supply chain disruption is really opening up or layering on new opportunities with our existing customers, right? So as these acute supply chain matters hit the market, some of our existing customers, we don't have 100% of their business. So they got faced with some out of stock issues, some supply chain issues. So they came to us for help. We reacted. That contributed to some of our Q3, low end gross margin performance, where we helped them out, understanding that we were going to adjust those prices in the future. And the reshoring of supply chain started to really, and diversifying that risk profile introduced in their supply chain. New customers were coming, trying to achieve that de-risking of the supply. So all those factors played a pretty significant role and continue to, candidly, as being a major factor in our growth going into 2022.
Okay. Well, since we're already there, let's talk about the macro environment and these supply chain issues, the inflationary pressures, the reshoring. Maybe you can walk us through, treat me like a kindergartner. How is this all playing out?
Okay, well, now you're wicked smart. So first it starts with...
For a kindergartner, maybe.
You're wicked smart. So it really starts with the ocean freight, container short imbalance, the cost of ocean freight, We do have supply chain lines that are tied into ocean freight delivery on resin. So, those played major factors, not only in cost increase, which I think everyone on the call is aware of, but also on timing, right? Delivery of anticipating, like we used to order material that would take 45 days of warehouse from the time it left port. Some cases it's now 100 days, 120 days. We anticipated that. Now I just want to give us a little bit of a pat on the back. Like we anticipated it, not to its full extent. So we built up our resin inventory. We built up, we pre-ordered because we knew this demand level was going to spike. What we didn't anticipate was the significant climb, and I don't think anyone did. And in Q3, there was a lot of commentary out in the market from policymakers that this was transitory inflation. I don't know if you remember that. So as these costs began to hit and the shortage of drivers and on-ground costs for delivery increased, this transitory inflationary commentary was causing a lot of confusion. Like people thought this thing was going to come and go. We took the position with our customers and our owners that, hey, this isn't transitory. I may have even made that comment on one of our calls. So the inflationary environment is real. The geopolitical condition has amplified it. And so we continue to maneuver successfully. And I would say not that we're not impacted, but we're proactively managing our supply chain with the priority of minimizing our customers' disruption. Because customers like what we just announced today with Forge Girl or Divvies or all the customers that we've announced, like they're growing businesses. They're on trend. They're growing. The last thing they need to be dealing with is some type of disruption. So we continue to prioritize that. We continue to manage our supply chain proactively, and larger companies that, having operated larger companies, it's challenging to move that level of volume with speed. So that's causing these opportunities, right? Where these larger companies are serving their top clients. A lot of these regional enterprises or small national accounts may be experiencing shortages. That is opening up opportunity for us as they're looking for help or they're looking now to diversify that risk. So we feel really good about how we've handled it. We have strong awareness. We have great communication with our customers. And I think we're gaining a reputation in our ability to help customers in a time of need through this crisis. And I think that condition and the macro environment isn't going to change in the near future. And, we take a lot of pride in being aware of the market conditions and adapting to benefit our customers and our overall business performance, which we've demonstrated since even COVID, like back in when this all started, when the economies collapsed 30%, we demonstrated our ability to grow nearly 60% even back then. So I feel really proud of the team. There's always room to improve. Like we need to have some humility that, yes, we could always do better. But I think we're in a position to benefit from these supply chain disruption, supply chain inflationary challenges. I think we'll come out of it much stronger as a business and much larger. So we're going to continue to take our strategic approach, and so far it's gone well.
Has the price increases for petroleum-based products, impacted your ability to switch customers over to more sustainable, or positively impacted, I guess I should say? Has that been a trend, or is it really more about the supply chain issues?
Yeah, I think the short answer is that just adds to that transition or openness to start the transition, right? So we're all being impacted by on ground or on ocean costs, right? Or fuel costs for transportation. But for petroleum products that are 100%, of course, they're being impacted and amplified at a higher cost. That is positive for us. Now, at the same token, clients need steady supply chain and consistent supply chain. So I think, as people are looking to diversify their supply chain and they come to us, it's a lot easier to have that switch conversation, not only to your point, but the fact that we can be a good, solid alternative and open up their transition to more renewable, sustainable product options. So it is a benefit, but I want to highlight it's not linear, right? It's not like, well, okay, well, prices are up, our business is going to boom. There's multiple demands in the market that are giving us strength in driving our growth.
Elaborate on some of those other demands.
Yeah, I mean, consumers like whether it's regulatory, provincial or federal or state or federal policies down in the U.S., whether consumers through COVID have a heightened awareness on their health and wellness. That continues to be a positive demand. Our biggest demand is the consumer. There's transition of decision makers in company as folks are retiring or transitioning into different careers. There's a bigger appetite in those decision makers, a look for alternative to petroleum, and now they're looking for reshoring or diversifying the risk in their supply chain, and that's opening up, opportunities for our growth. So, it's really dynamic in on the demand side, and for us, it's just navigating our supply chain effectively in fulfilling the opportunities that are being presented to good natured. So
can you talk a little bit more about the reshoring and how you're able to do that effectively versus maybe some other groups that aren't as successful?
I'm not fully this is kind of my intuition. There's some articles that are coming out supporting this point of view from different individuals and organizations, but I do think this global supply chain is being tested, right? In other words, it's being questioned because of what's taken place over the last year to 2 years. And I think a lot of companies are well ran by very capable individuals, and they're learning and they're adapting, and so they are looking at moving some of their supply chain here to Canada or the US. They may not be 100%, but they may move a third of it or half of it. And I think what we again made some investments early on to increase our capacity through our high-speed machines, right? The high-speed extruder that we put into IPF. We also put in some robotics and high-speed equipment into our Shepherd facility. So that's going to grow our capacity. That enables us where someone comes and says, hey, we're looking at reshoring. This could be a great chance for us to start to transition. Can you do this for us? And so I think we built that capacity, what we call in-house, which is our own manufacturing through our technology investment. But we've also expanded our outsourcing capability through third-party manufacturing. So we think we're in a good position to take on additional reshoring business of material size, and I think we will benefit from it. So that's how we've kind of laid down some of those capital investments, not 100% to prepare for the reshoring, obviously, is to prepare for our growth. And because of that, we can capitalize on this reshoring trend.
You mentioned earlier today, as well as the last time we spoke, just about increasing your inventory of certain products to ensure that you are able to meet customer demands. Are you still increasing inventory in that regard?
We are, and we have. So as we come out with our year-end statements, we continue to build up our material, particularly on the resin side. We do have some finished goods too. That's what we did in Q3. But we're also mindful, right? We were managing our open to buy and making sure that we're hitting our inventory turns, but we also need to adapt those targets based off the timelines of delivering materials to our warehouse or our facilities. So it'll be a combination of, okay, now we're adapting to 120 days, so it's going to take a little bit longer, and that may mean carrying a little bit more inventory levels due to those timelines.
And ostensibly, you're paying higher prices for the inputs.
Oh yeah,
your product.
absolutely. Yeah.
How are you managing that? Are you able to pass on some of that inflationary cost pressure to your consumers?
Yeah, I mean, Q3 was probably the most challenging time because, again, that narrative that was out there of transitory, people didn't quite understand it. I think now it's changed quite a bit. It's really amazing how businesses and leaders adapt. I think everyone understands that we are seriously in a concerning inflationary environment. And so what we do now is it's not a matter of our prices going up and our prices being passed on. It's more about communicating it, doing our best to coordinate it with our customers. So, because if you're a food producer, you're selling to retailers, they may have certain windows that they can do pass on price increases. So we're trying to balance that to our best of our ability with our customers. And passing on these increases are definitely more accepted in the market. The challenge for, frankly, all of us in the marketplace is logistic costs. Gas prices at the pump have jumped overall. And that's having, not only impact, our logistic price costs and pricing are quoted every week, right? So if I give you a price increase today and logistics goes up 20% next week, there's always that lag that takes place. So, we've adjusted that. I've done our best to address that with shipping surcharges. Mm-hmm. One, to give our customers visibility to, okay, I've got my price increase for my products and I have this shipping surcharge that is going to flex with what's taking place in the fuel transportation markets. And so far that has worked. Again, there's room for improvement internally, but we definitely have a good plan in place. The team's executing it. Marketplace is getting adjusted to it. So far, I would say we're definitely in a different place than we were in Q3 overall in the market.
Mm-hmm. Okay, and that kind of brings us full circle back to talking about the Q4 numbers. Is there any seasonality in the business that you're seeing?
No, there really isn't. And I mean, our business is more impact on timing, right? So I got, $1 million going out the last week of the quarter. And for whatever reason, trucks didn't show up, production was off a day. It doesn't go out, right? So, we anticipated this production, customer calls and says, hey, I need to push that out a month. We're more impacted by that. I mean, there's a little bit of seasonality between Q4 and Q1, but we're more impacted by timing. So when you look at, for example, Q3 sequentially to Q4 revenue, it's all the acquisitions were baked into Q3. You look at Q4 sequentially, we grew, I think it was approximately 25% or roughly around there. That's 100% organic growth. So, and that's all public domain information. So, that's not seasonality, right? And that's a good way of comparing, 2 quarters sequentially on growth and organic growth improvements.
Mm-hmm. So that type of organic growth, I know you target 50% of your growth to come from organic and 50 through acquisition. Is that still your current target?
It still is. I mean, that's kind of our bullseye that we aim for. There'll be some years where our acquisitions will be higher in its contribution, and other years organic will be. So we kind of look at that target in a kind of rolling 2-year. And we look at, we communicate our GAAP and non-GAAP organic growth at year end. So that will be provided here when our financials come out in April. And I just want to share a little bit of dimension on our organic growth. So when we acquire a company like X-Tech on a $33 million Canadian annual revenue basis, just simply put, we divide it by 12. And that monthly revenue, when we perform higher than that, we treat that as, hey, we've gained productivity on that acquisition, and we treat that as organic growth. Now, organic growth is revenue after 12 months. So, the way we're viewing it is more of an internal metric. But it's important for us to ensure that, when we acquire these companies that were driving incremental growth, right? And that's our plan with our acquisition strategy. We don't just go out and acquire a company freestandingly. It fits into a broader strategy and supply chain. And my expectations that, are collectively embraced by the team is, hey, if we're doing, $33 million in this acquisition, we need to start add more revenue to that. That's why we incorporated it, or leverage it into more intercompany business to drive our packaging growth, or a combination of both. So, but all those metrics will come out here in the coming month, actually in April.
Okay. So your fully audited numbers, and I think your Q1 numbers will be out in the
our Q numbers will be out in May.
A little while as well. Is that right?
Yeah, they'll be out in May.
Okay. And just as a reminder, as people are putting in questions, just keep in mind that the Q4 numbers are unaudited, and because those two releases are coming out, there's certain questions around financing and other things that we can't really address until the full picture is out there. But I think my internet's gone a bit unstable. Paul, can you still hear me?
I can still hear you. Yeah, you're breaking up, but I can hear you now.
Okay, sorry about that. So I guess just moving on to your plans for 2022. 2021 was a formative year for acquisitions. You did 2 strategic ones. You've positioned yourself for pretty good growth this year. Maybe you could talk a little bit about your plans for 2022.
Yeah, I mean, we continue to remain focused on executing our strategy, right, that you highlighted, and also leverage some of the strategic investments that we have made, particularly in the acquisition. So I'll just first highlight, like, half of our growth this year will be targeted organic and half of it through acquisition. So we continue to have a robust acquisition pipeline. We still have a very robust organic pipeline. Just recently, announced our new Tamper Evident line, Good Guard. So, all that is very strong. We're very focused on executing it. And I think the biggest thing for us strategically this year is we really, in 2021, we built a high ground with acquiring 2 sheet extruders, IPF and X-Tech. And, we brought on some great people and long-term, the skill set we've got, and a fantastic group of customers. And so what we want to do is continue to build off of that acquisition by taking that expertise and taking that capability and directing it towards our packaging business. We're really looking to strategically drive our packaging business this year, along with our, what we call our general merchandise, or our consumer business group. So that's really our primary focus on our growth going into 2022. And we're going to do that both organically and through acquisition. So that way we're building off of the 2 transactions and aiming it towards where we really want to drive growth, which is in packaging and general merchandise.
Okay. You put out a fairly good shareholder update recently. There was one, or actually there's 2 parts that I wanted to expand upon a little bit. Sure. So you mentioned key technology investments that are being made to enhance operational capabilities and the predictive tools that are being deployed to deliver anticipatory service to customers. Can you elaborate on what this means?
You want to decode that. Okay, so
yeah.
You can only, that's why I love calls like this. So it's really hard to, put in so many words into a press release. Well, basically what we've done is we need to gain productivity inside of our organization, right? We've acquired, several companies. We're operating off of multiple platforms to run these businesses. Then we're aggregating them. It's a big manual process, and a lot of that decision on data, because I'm a very data-driven, I'm a data-driven CEO. So as we're curating that data, there's a lot of interpretation and bias and preparation, and with the deployment of a new ERP system that's consistently used across all of our business platform, which incorporates AI predictive modeling tools. One, it builds efficiency in that whole process. So removes a lot of manual entry, removes a lot of bias because the system's coming and telling you, hey, here's a customer group that is absolutely on fire and here's their profile, go find more of them. Or it's integrated into our high-speed technology manufacturing equipment, and we're able to see those yields or those exceptions that are coming and saying, hey, here's an issue. And to me, that data decision and recommendation coming from the system will enable our leaders to make very effective and timely decisions out in the marketplace around customers or production or cost controls or positive trends or quickly address any type of negative trends. But at the same token, that technology will allow our customers to engage with us. That also drives their productivity and ours at the same time. So, our vision is if you're a customer, and let's say you're a regional customer, you're a food producer, on your mobile phone, bang, you're getting your, hey, here's good natured sending you, here's your demand going in the second quarter. These are by SKU. This is what we predict. This is what we do. Click here to accept. That takes, how many emails and video calls that saves? It's tremendous. And that customer is getting a simplified, easy, we call it easy and affordable. This is the easy side of things on how to manage their business, how to manage their inventories. We can, et cetera, et cetera. So we really want this platform to be a better way for our customers to engage us and for us to service them. Now, when you take that along with our robotic high-speed equipment, we're laying on a foundation for productivity. I get asked all the time about EBITDA. EBITDA, where are you in EBITDA? Now, we're a growth company, first and foremost, but we're mindful of EBITDA, and we recognize that we need to improve our EBITDA. The way we improve this EBITDA is not purely on price and cost, but productivity. Right? We want to create a platform where we can do more with less. And we think the height, just to reference again, I'm sure a lot of folks on the call may have already heard me say this a million times. These high-speed equipments, they yield more per labor hour, right? So our people could do more production across a wider group of people, customers, and you combine that with the ERP system, we're really setting the stage for, EBITDA improvement and higher productivity going into 2023. And, when you look at the labor market and you look at the headwinds of inflation, this productivity isn't going to yield all to EBITDA, right? It's also going to help us stay much more competitive in an inflationary environment. So some of that gain will be directed commercially to, address the affordability side of our equation. Remember, we're really focused on easy and affordability. So this technology, we're pretty excited about it. We think we'll really begin to see that gain in 2023. And I think this consistent investment on robotics and high-speed technology is going to be a continuous theme going into the next 2 to 3 years because of the reasons I just spoke to.
So what I'm hearing is the high-speed equipment, the robotics combined with the ERP is really just a way for you to show productivity improvements, and hopefully that translates into EBITDA improvements or some equalization in a rising employment labor market.
That's a great summary. Yeah, I do expect EBITDA improvement from that, and we anticipate it, and we do anticipate that some of that gain will be aimed for commercial purposes. So, but I think more importantly, I just want to reemphasize, and I'm pretty passionate about this, so I'm probably taking up too much time. These investments will yield productivity, and we have to make them in this environment, and we have made them. So I think we're setting the stage, just like we anticipated this supply chain disruption. We're setting the stage for a very strong 2023.
Is energy efficiency part of this initiative as well?
Yeah, sure. Like utilities is a big cost line for us. Like, when you look at technology, I can't, there's just to be really clear, we have not done anything like this, but I will tell you a little bit about our aspiration and what we're dreaming about is, utilities is a big cost, and utilities on a GAAP basis is rolled into our cost of goods, right? So that's why our gross margins are impacted by that. So we're beginning to challenge ourselves. Is there something we can do? I know retailers do this. I remember in my days where, can we structure power inside these facilities to drive down our utility costs, whether that's through, a battery source that we're charging during off grid hours. So there's, they get charged up on lower prices, and then during peak time, utility charges, we switch over to batteries. So we're dreaming about this, but ultimately we have to move into this type of mindset to support our affordability aspect of our business model. And I then want to reassure all of our owners or potential owners on the call that technology will continue to play in our facilities, how we, through our tech ERP system, are selling online, engaging our customers. That is going to be a thematic going into the next 2 to 3 years.
Okay. Also seems to be aligned with your North Star, which you didn't touch on this webinar, but I'm sure you'll get to it eventually.
Well, everything we do is orientated towards that. So, our North Star, becoming North America's leading earth-friendly product company, is what we use to align all of our stakeholders. And I think now, I think in the message I sent in the owner's letter, in a time of challenge, which I've never been in a business that hasn't been faced with challenges. This period is unprecedented. I've commercially operated for many years, and this inflationary supply chain environment is, anyone who says they've seen it before is, I don't think is an accurate statement. This is very very challenging, and I think for us now is the time for our stakeholders to be steadfast, locked in our arms, right? And we're locked as owners, as a board, as operators. Like, we are charging towards this North Star and believe that this disruption is opening up opportunities. We should seize these opportunities in a mindful manner, and I'm confident we are. And so far, we're demonstrating it. So I'm not just saying it. Like, we want our numbers to reflect our behaviors, and I think our past numbers do that.
Mm-hmm. Something popped into my head, and also
Sure.
Clearly one of the audience is on the same wavelength as me, because they asked the same question, and I haven't asked you this before. So
Sure.
Wading into new territory. I hope Spence doesn't beat me later. So by replacing petroleum products with plant-based products, are you eligible for marketable carbon credits? Is this an area that you've looked at all?
Yeah, it's a really interesting question. I'm not an expert on carbon credits, but there is a carbon reduction, and arguably we could provide pretty strong traceability to that. So would we be open to that? I would say I don't see why we would not consider it. Have we looked into it? In our early days, we were introduced, I can't remember the year, but it was in the early days that we began to explore that. And I knew it had to do with some traceability and how we traced it, and we found like we could. So we definitely would be open to it. I have not engaged in it. That would be a great ask for Spencer to look into.
Yeah,
I think it's actually an interesting idea, and we should reopen it because we've got the data, and that's definitely something we could trace.
Well, that makes me happy, making work for Spencer. So I have a couple other audience questions that I'd like to address. So there was one just asking, going back to your wage cost pressures, can you talk a little bit about what you're seeing in terms of that on the wage side? I think you have 200 employees, so just maybe you can give a little context.
Yeah, I think it's really important as a group of owners that we keep our team members engaged. And, we have a great group of people running our facilities, tremendous. I was out there touring them, and they're highly engaged. but the reality is like we're all faced with life inflationary cost increase, whether it's at the pump, whether it's with food. Like I went on, did some grocery shopping. I'm like $100, like really? And so we really need to be mindful of that. And we are taking steps through our merit process and in supporting our team members as their families are faced with these inflationary. And we've also have, short-term incentives, and, we want to pay for performance. But these are factors that are real, and we need to retain and attract the best and brightest people out in the market. So it's something that is very topical for me. We need to make sure that this is front and center in our company, taking care of our people. It's a value for us as owners to have this mindset. But and it needs to get balanced too. And so if the labor pool is shrinking, we need to be clever, and we need to be unconventional. And how do we improve our output? It's all technology. How do we simplify in the time to engage our customers? It's all technology. How do we simplify on getting real-time decisions for our operators? It's all technology. So the thematic at Good Natured around robotics, high-speed equipment, technology engagement, we've entered that era. And I think we have to continue our ambition of our growth rate. And you got to remember, we've grown for the last 5 years over 100%. Like this year, 2021 is like well over 240 or north of 230, right? So, we're going to continue to sustain this growth rate. We need technology, and we've activated. So I'm not just talking about it; we've done it, and we're going to continue to make these investments. So it's this labor market. That technology isn't designed to replace our great team members. It's to complement and support a labor market that is shrinking. And so I think the combination of great people with technology is a deadly combination as a competitor underpinning this business model. So I think it sets the stage for the next 2 years. And I'm really I've never been more ambitious. I've never been more confident in the opportunities in front of us. Like I see things like, customers that are calling in, right? Inbound calls, all-time high. I've never seen so many freaking inbound calls. It doesn't mean we convert them all, but it's a leading indicator. So, as I look at these leading indicators, I feel bloody good about, that's a British term. I feel really good about, it's my Brit coming out, very good about how we're setting the stage inside Good Natured.
Okay. Well, I want to get into your growth strategy a little bit, but I have 2 audience questions related to gross margins. So maybe we'll just address those and then we can move on. So one of the questions came in a while ago, I should have inserted in the conversation, which was if you take on a client at a lower than average margin, how long does it take to move margins up to more acceptable levels, weeks, months, or contract by contract? I'm assuming different types of business have different margins, et cetera.
Oh my, this person must be a relative of mine, because I think of that all the time. The short answer is I like it to happen like yesterday, but the hard realities of it depends on the circumstance, and it does vary. So I can demonstrate a few hypothetical situations that maybe will answer the question. So let's just say there's existing customer, they get trapped by another supplier and they need let's call it a 24-ounce multi-purpose container. And they've set their price points in the market, right? So they need a fix like yesterday. And this is a stock item. So we've already produced it, right? It's inventoried. And I say, okay, Deb, I'm shipping you 9 pallets. I'm going to maintain that price. But when can you make the adjustment to this price? Deb may tell me, end of the quarter. Well, that could be a month away, or that could be 2 months away. And we say, okay, end of the quarter. That 9 pallets is not going to materially change the overall business. So when we look at these exceptions that are, derived and decided between our team of leaders, you're not going to see that. Now, let's just say it's a new customer who wants to make the switch or whatever condition wants to change, and they say, hey, these are the price points we need to hit. And we say, well, look, we understand your circumstance. This is a pretty significant impact to our business. We can only do it for X long. So we'll time box it, but we're not even going to activate it unless they agree to the new price point. Now, in third quarter of last year, those conversations were quite challenging because this transitory language, again, the macro communication, it caused a lot of confusion. That is not the case now, right? So people understand that prices are moving, costs are moving, people are passing those costs on. All of us are feeling it, frankly, when we go shopping now. And so it really depends. Now, if someone's not willing to take on the new costs or the price to support the cost, look, that's okay. Like, there's so much business for us. We can say no. We don't, we're not going out grabbing low margin business if it doesn't fit into an overarching mix plan or an overarching pricing plan with that customer. And again, we don't gouge our customers. We're very affordable. Like, we don't go out there and, our goal is to drive as much growth as we can within our targeted gross margin range, 21, 28. Like, sometimes when we kind of role play the third one, say we acquire this customer and they're high volume and they're lower margin, but within our margin range, we call it 21%. Well, the way we complement that is sometimes that's the price you got to do business at with that customer, right? I mean, you want that customer, low margins, high volume, that's not a bad thing. But what we do cleverly, because of our diversity of products and that presentation, that's the best way we know how to present it. We'll start going after small businesses. We'll start driving more packaging sales through our e-com platform. We'll go out and drive some more regional business, and we look at that mix profile. So, if I'm doing $1 million at 21%, I may need to layer on $200,000 at 60% to move that to 25. And so these mixed margins, it doesn't take that much revenue at a high margin rate to bump up that $1 million in revenue up into the middle of the fairway. So sometimes we change that mix outside of that low margin customer. So I hope that makes sense. Like, I'm a mixed margin revenue. Like, I love the magic of mixed margin. So I hope that answers the question there. But those are kind of three, kind of scenarios that are real, and some of the ways we address gross margins.
Yeah, no, I think it makes perfect sense. And with that address, let's move on to your growth strategy. We've talked a lot about organic. You've referenced the acquisitions that you've made, but maybe you can give us kind of an update on the acquisition environment and further opportunities to grow by acquisition.
Yeah, well, the opportunities are very real. They have not gone away. They have not dissipated. We continue to focus to execute it. The environment has changed. This reshoring of manufacturing has moved the multiple range up. I think we communicated before across all manufacturing was between 7 to 12. I think now we're seeing 9 to 15, multiples of EBITDA due to this supply chain disruption. Now, obviously, we still think there's tremendous value inside the acquisition space, and quite confident in our team's ability to continue to execute on it. Now, I'll also highlight this whole geopolitical, probably last point on this. The generational transition for petroleum-based product and packaging manufacturing is very real. And still very green. And I think the geopolitical environment just is another amplification. This inflation is another amplification. COVID, was the starting point. So we still think it's very rich opportunity. And all the data, independent data, if you read for folks that are geeky like me and read all the M&A news, it's record, right? There's record transactions out there inside of our space.
Okay. And then in terms of, looking at M&A opportunities, you've done a couple big transactions in the last few years. Would 2022, should we be expecting another big one? Are you looking at some smaller opportunities? Obviously, there's still some digestion that has to happen within the company. So can you maybe guide us a little bit on what we can expect this year and next in terms of sizes of acquisitions or what types of businesses you look at?
Yeah, I mean, I would tie it back to the question around gross margins, right? So, we're way over mix in industrial revenue. We are not an industrial roll stock company. And a majority of our revenue, when you read the MD&A, you'll see like we're way over index. So our motivation now is to balance that mix because industrial is not our highest margin space. So we want to turn around and add additional mix in packaging, add additional mix in general merchandise, add additional mix of revenue out of services. So that additional mix will come through acquisitions and organic. So I would really see us putting a big emphasis on M&A in packaging, general merchandise, and services. So I think that's where that will help bring in a different mix profile into the company. But we're not going to just do it through M&A. You got to remember, we secured $17 million, approximately $17 million annual large U.S. food producer, and we announced that, and that's going smashingly well, and we're still negotiating back and forth, but I feel based on everything I'm seeing, and everything looks very positive, and the business is moving along quite nicely. So I it's got to be a combination of both. Like, we don't want to be a company that's buying acquisitions just to get revenues. It's got to fit into the overall supply chain. It's got to fit into the overall business model. And any acquisition we do, we'll do that now. If we can find an asset that is underutilized, right? So say it's doing, again, this is all hypothetical. Say it's only doing $2 million a year, but it's got capacity to do 30. It's an extreme example. But you know what? We'd love that capacity. Why? For all the reasons we talked about: reshoring, getting access to that capacity, putting investment into it, resources, technology. We'd be open to that. If we can get a good deal on a large transaction that is priced well, we'll be open to that. So we're looking for different mechanics in making those decisions. It doesn't need to be giant. It doesn't need to, but if it's small with lots of organic opportunity, we'd be open to that type of transaction too.
Okay. What I'm hearing is like you're looking for maybe more bolt-on type stuff that'll help you gain customer base, like that geographically fit with where you are, and a large transaction potentially if it's the right price and the right fit. Would that be an accurate summary?
Yeah, it's an accurate summary. Like, I think for us, we would be equally excited on a smaller revenue with lots of capacity as a larger revenue with very little capacity. So, I think we'll assess each of those opportunities uniquely, but the fundamentals of what you talked about also underpin it, right? Geographic location, it's got to fit into the supply chain. It's got to help balance this industrial revenue, right? With packaging revenue, general merchandise revenue, or service revenue. So as long as it kind of fits those broad parameters, and again, it's got to be priced right. We want it to be a good price for the seller and a good price for good natured, and so far we've been able to do that. find transactions that meet that standard.
I think historically your threshold was somewhere around 5.5, 6 times. That's what you were looking for. Is that correct? Has that changed with the increase in multiples that you've seen in the industry?
Yeah, I think the short answer is yes. Like I think the 5 to 6 due to this supply chain conversation we've been having, I think it's going to that range is going to move up. Like it depends on the type of converter too, right? That drives that range, but I expect us to be paying a higher range than what we've done in the past.
Okay. And then I don't expect that you're going to tell us if you're close on anything, but that is one question that I had.
I always say, the best way to predict our behavior is to look into the past. So, we're definitely out in the market very actively commercially and very actively on the M&A side. So that's about as much as I can say.
Okay. And what is the most important strategic move you would make with Good Natured today? Would it be to drive more organic growth, make more acquisitions, expand the product line? Like, obviously, capital's, you're going to direct it somewhere. What's your view on what you would like to do?
Yeah, I think the biggest strategic priority is to bring balance into our revenue mix. We're a revenue mix model, and when we get over heavy, either by business group or by a single customer, the model really doesn't work. And so strategically, we need to prioritize the balance of our revenue contribution, not only from a business group perspective, but also across our different product lines. So that's something that's very topical for me. And then the second would be productivity. We want to drive productivity for reasons I think a lot of folks on the call know. Improves cash flow, improves EBITDA, improves affordability. We need to continue to put money into technology, the technology conversation we had earlier. I think those are the two things that I'm very mindful. And then this inflationary impact to our people. I talked about this frequently. And so for us, it's all about making sure we create a great environment for our people to not only work in and thrive and grow their careers, but at the same token, we need to make sure that we are keeping up with inflation and providing incentives for their performance that help offset some of the costs that them and their families are faced with. So those are the three, I would say, swim lanes of interest of mine, as I view as top priority.
Okay. That's great. Well, moving on to what I think is always my favorite section,
Sure.
which is the products. I find some of them so innovative and cool. But let's start with, you had an announcement this morning, I believe, for Forage Girl
Oh,
for
yeah.
Fiddleheads packaging. Maybe you can talk
Have
a
you ever
little
had
bit
any?
about
Have you ever had any before?
Fiddleheads.
Yeah.
Yeah, not this specific brand, but yeah, they're not my favorite thing, but
Or
I
not?
know
I
they're very.
love
But yeah, maybe you could talk a little bit about this contract, why it's what the importance of it is. I know you don't release all of the contracts or clients that you sign up, so maybe you can give us a bit of a rationale as to why this one's important enough to have a release go out.
Yeah, I've gotten a couple of inbounds on this too through Spencer. So when we choose a commercial release, it isn't purely driven off of our transactional value, right? We look at it as, we are targeting our marketing spend towards certain customer groups that we view as they have a high adoption rate to our products and a high growth rate, and will lead to more additional customers within that segment. And so when we do these releases, as much as it is to inform our owners, it's actually designed to attract more of our customers. And we put Stephanie, who's head of our chief of strategy and marketing and branding. I call her the chief psychologist. Like, she has a technology platform that optimizes that press release, so algorithms can grab onto it and it gets, real significant exposure. And that's really to get more customers. And so we pick these releases based off of readership and our targeted customer group. Now, I balance that by saying when we do that, we aim for the middle, but there's a halo of other customers that get attracted to that. So it's kind of like the analogy of a Harley Davidson, right? It's got that real, tough lady or tough guy riding the bike, but it's the dentist that's buying it, right? So, there's a halo impact that we do, and I don't want to give all of our secrets because I think this is being recorded and published, but we're very purposeful on how we do that, and it's not going to be every contract. Like we layer on, I don't know how many customers every freaking week. So we're very, the team's very purposeful with who we release and when we release it. Obviously, the materiality requirements and compliance requirements is definitely a condition. But outside of that, we concentrate on our marketing efforts. It's the main driver.
So it's not all about capital markets? That's disappointing, Paul.
Oh, come on. It's all about growth, right? It's all about growth. That's our focus. That's our becoming North America's leading earth-friendly product company. So there's some underpinnings to all this. So the short answer is capital markets are important, but they're not always front and center of why we do releases.
Look, you're running a business. That's number one. You've got to do things that make sense for growing that business. But yeah, I'm interested in that product. It sounds pretty cool. Can you give us a little bit of detail about it?
Yeah. Well, I mean, I think we've launched a series of great products, from Good Guard to the product in this release, and even our high heat takeout containers. So you kind of mentioned, like, what's the priority? Like, we do need to continue to develop product authority in a range of products that are on trend, that are complementary. So, if I can just maybe speak to Good Guard, like what Good Guard is it's focused on this food security, tamper evident packaging that most large grocers are now requiring for food safety and security. And basically, in essence, if I was working in the store and I went to the shelf and if I see a package opened, I can tell if someone opened it because either like some tamper evident have a tear strip. Mm-hmm. There's this little plastic. So I know someone potentially had tampered with that, and I take it, throw it away. What's unique about Good Guard is not only is it on trend, and we've launched it with multi-purpose containers, so there's lots of usage for them. We don't have that tear strip, so it basically locks together, and if someone opens it, it doesn't reseal. But there's not that tear strip that basically you can't do anything with, right? Just throw it in the trash. So we don't create that little plastic waste from that tear. And we're really excited about that. And I think, our big focus on sustainable products is not purely on the material, but creating designs that use less plastic, are right-sized, are being produced at the right gauge. So we're trying to use less material inside of our packaging, or packaging that doesn't cause these tear strips that end up in the trash. So all this, we got a great engineering team that is constantly looking at ways of creating designs that are on trend and really focused on the sustainability aspect of our design.
Yeah, well, Good Guard sounds like a really interesting product. I think at the release you mentioned that there's regulation coming into place in California and potentially some other states that require, I think it's food delivery services, to have something like this in place. I mean, it's a screwed up world that we live in, that we can't, trust people to not put stuff in our food coming from the restaurant or the grocery store or whatever. But yeah, maybe you can talk a little bit about the regulatory forces.
Yeah, I mean, I think the COVID's created this, and unless you live in like New York City or some of these large metropolitan markets where takeout's kind of front and center of that culture, like I think everyday people now in all type of cities have had food delivered to their homes. And so when you look at you probably have seen if you order some sushi or you order some product, they do tamper evident with a label, right?
Yeah.
A piece of label. And so, or they don't do anything. And so what's great about GoodGuard is once you seal it, it's locked. And so when you get your food, if that seal is broke, one, you don't have a label, which is you're saving the label, right? You're saving that, and from a cost perspective, but also it also impacts recyclability with when you put a label on a product. But it meets that standard that you're speaking to, which is, I think more and more California and several other states are looking to adopt that policy that all delivery products need to have that tamper evident seal like GoodGuard has. So again, we think that's beneficial. We intend to expand that line, but also it's really centered on large food retailers, right? Their adoption rate for this design is accelerating. So I think it's a table stake design, and we think our design's better than the ones that are out there. And I want to tell everyone that we submitted a patent pending. So this is very novel technology, and design. And we designed this specifically for biodegradable materials. It's very unique for that. So there's not a lot out there for biodegradable materials in this tamper evident design, and GoodGuard can do our bioplastic, but it's specifically built for biodegradable. So we're pretty excited about it. We think this one's going to be I call it a growth horse for us. It's going to be really good.
So will this be a separate line from your current takeout delivery ones, or will this be a technology that's added on to that category?
Yeah, it'll be added on to that category. So it'll be used in food. Just imagine like anything in your grocery store, bakery, or dairy deli. And then we'll extend it into takeout. Now, the multi-use containers where we're starting for can be used in takeout and in grocery. So we're starting with this real versatile line to maximize our investment because the application is quite broad in the designs that we're launching with.
It'll be reusable, microwavable, dishwasher safe, all the same that you currently have with the takeout containers. Did I get that right?
It could be if you make the product using that material, it could be, but it doesn't have to be. I think this whole reusability is really important, and our takeout containers were definitely designed for multi-use. But the short answer is it could be if that's the material the customer chooses to go with.
Mm-hmm. Well, I still think it's crazy that we get our food in those like black takeout dishes that a lot of the restaurants use, that that all the plastics is being leached into the hot food. But yeah, no, I my favorite product line I think is the reusable, microwavable takeout containers.
I love that. I love that product too, and I love. I know it sounds very blah. I love our trash bags. If you haven't ordered our trash bags, if you're listening, go to Amazon and for the love of pizza, order our trash bags. Phenomenal. Great price, great product.
You've got Ziploc bags and other things like that.
Yeah, we do. We have zipper bags and freezer bags and sandwich bags. I like the trash bag. I always feel gutted, right, when you take your trash out there and it's this poly bag, petroleum bag. So I really like our trash bags. They're big a plug. Let's get those sales going on trash bags.
You just have to offer a discount and a code or something.
Oh,
let our editor know. We'll have it edited on.
Next time we'll flash a code for the next 30 days. Enter this promo code.
I guess the last question that I have about product development is, when it comes to product development, sure, how is development divided between enhancing existing products, similar products, versus moving into brand new product areas?
That's a real good question. That's kind of buckets under our assortment management, and it's a skill set that is very common in retailers, and a skill that we're working really hard to develop inside Good Natured. And I think there's been a ton of improvement in this space. So what we do is we look at these trends, and I'm going to try to say this really quick. We look at product life cycle, and if a design is becoming old, kind of like a CRT TV, so maybe some people who don't even know what a CRT LCD TV versus a 4K. When the designs begin to transition into either a good guard and out of traditional, we do look at delisting those products, or we carry them specifically on special order. There's some products that enter a life cycle that we completely get out of, like, our kind of founding category, which many of you may not know, is our company was built off of desk organization. That's where our brand started. We built those products under the Good Natured brand. That brand extended to Good Natured as a company, and it's our founding category. But we've since then exited it. So we want to make sure that our capital management, it's equally important to the products that we exit out, but also, we want to make sure that we're refreshing our product lines or introducing product lines that open up new cross-selling or new categories for growth. So it's not linear where you focus on one. You have to focus on all of it, and it is bookend by capital, right? So, we set a capital spend on not just fixed capital, but just investment dollars, working capital dollars, and we incubate these because large companies suffocate innovation, and we don't want to fall in that trap where we're just focused on, hey, we're doing a lot of industrial, let's just go for industrial. That's not our model, and if we do that, we lose that innovation that underpins these new product launches or refreshing. So it's not one or the other. It's managing that life cycle within a financial parameter. It's probably a better way of summarizing it.
Okay, that makes sense. And I think we're well over the hour, so probably a good time to wrap it up. Before I let you go, though, we talked a lot about, plans for 2022, Q4 results, product growth. What we haven't really talked about is specific catalysts for the stock. I was looking at a bunch of research reports before we did this session, and it's very clear to me that the stock remains undervalued. I think you truly are a disruptor in the space, and at some point you will deserve that multiple. So maybe you can just give us some of the things that investors can look to, some reasons to own the stock right now, just to leave it on a high note.
Yeah, well, I mean, I think first let's just target the value that you just highlighted. Like if you look at this, I was talking to an owner earlier today that had been involved and remains an owner for, I don't know, since 2017. And I think what we want to do is always put a horizon on our investment, right? Call it 3 to 5 years. And that's really paid off for that owner. And we were chatting and saying our share price today reminds me a lot of that 2017 year where, we're really undervalued. We were talking back then about a $100 million horizon, and here we are. And so I think it's a great entry point based off of comparisons of multiple of revenues to 2017. I think our catalyst for our stock outside of executing our model is just, delivering strong revenue growth. I get a lot of feedback on potential when I talk to new owners. They're like, "Can you sustain this growth rate?" And I always say the same thing. Well, look at the past. I think as long as we continue to sustain this growth, I think that will, continue to attract large institutions as we size up the company. I also think our execution on the M&A side and our execution on our organic side will play a big factor catalytically. And I also think that the sentiment for microcap, small cap, which has been quite challenging, right? So we're not the only ones who've been impacted. I think will improve. But ultimately, we need to execute, I think, on our strategy against larger comparisons. I'm confident we can do it, but our actions will speak louder, than my words. So, But I do think this is a great time for entry. I get when I say that, I had a few folks say, well, why aren't you out there buying? I'm blacked out. Like, I can't. So, I'm under some certain restrictions based on my position and visibility. And, but overall, for owners who've been around here a long time, it's a lot like 2017. So, take that into consideration when, if you're an existing owner strengthening your position or a potential owner looking to enter.
Mm-hmm. Well, I think, as you said, I mean, the company is in a fantastic position. You continue to execute. I think there was a while that every time I had you on for an update, you'd made at least one acquisition. So you've certainly proven the model. You've proven the integration, the growth, both organic and through acquisition. In terms of what I've seen over the last 2 years is, as you referenced in, I think it was your shareholder update, your trading volumes increased a lot. You've got 7 analysts covering you now. I think one's from a large financial institution. So you're definitely getting that market penetration and the market cap growth, revenue growth. And, I've been in the capital markets for 15, maybe 16, 17 years now. And it's not often that you see a company that continues to deliver and, the multiple doesn't eventually reflect this. So I think you're in this interesting situation where you have a really great business and it's shown really, well, the management team's shown really good execution and the market hasn't fully figured it out yet. So I think that's where I'm a shareholder. I've been a shareholder, I think, since the first webinar that we did, maybe even before. Mm-hmm. And I keep adding to my position because every time I talk to you, I think, wow, you've done so much with the business. I don't understand what the market's not getting. And usually when I feel that way, the market eventually catches up. So I think that you're just in that funny situation where you really are a value stock in a disruptive industry or a disruptor to an industry.
I think that's appreciate that perspective. I agree with it. I would also share, like, we're such a different company from 2017. Like, I don't know, 80 million in assets, over 850 customers, 400 products. Like, I don't know, back then, I think, we had 20 customers. Like, I can't even remember, maybe 50 products. So, things have changed, right? So we're such a different company that you're sharing this point of view on than we were back then, right? But I appreciate everything and all this time, and I'm very grateful for your continued support. And it's great hearing from potential owners and owners ask these questions. And we really pride ourselves in our accessibility to our owners. So if there's any questions that weren't answered, please contact us directly through our investor site, and we're more than happy to further the conversation for folks who either didn't ask a question or did and we didn't have time to answer it. Yeah, there's a few that remain in the box that I'll try and follow up with. I appreciate everyone's time. Thanks for joining us. And Paul, thanks so much for your time as well. And congrats. Looking forward to seeing your Q1 numbers. And I wish you a really successful year. Thank you. Bye, everyone. Thank you.